Roth IRA or traditional IRA? Which one should you choose? It's one of the most common questions in personal finance, and getting it wrong could cost you tens of thousands of dollars in taxes over your lifetime. But here's the good news. Once you understand the key difference, the answer becomes a lot clearer. In this video, I'm going to break down both accounts in plain English. No jargon, no confusion, so you can make a confident, informed decision about where to put your money. Whether you're just starting out or thinking about converting an existing account, this video is for you. Welcome to Economics 1144. If this kind of clear financial education is helpful to you, please hit that like button and subscribe. It means the world to this channel. Now, let's break it down. Let's start with the traditional IRA, which stands for Individual Retirement Account. Here's how it works. With a traditional IRA, you contribute money before you pay taxes on it. That means your contributions may be tax deductible, which reduces your taxable income right now, this year. The money inside the account then grows tax deferred, meaning you don't pay taxes on the growth while it's sitting in the account. The catch? When you take money out in retirement, those withdrawals are taxed as ordinary income. You're essentially making a deal. I'll pay my taxes later when I'm retired in exchange for a tax break today. Traditional IRAs also have something called Required Minimum Distributions, or RMDs. Starting at age 73, the government requires you to withdraw a minimum amount each year, whether you need the money or not, and pay taxes on it. For 2024, the contribution limit is $7,000 per year, or $8,000 if you're 50 or older, thanks to the catch-up contribution. Now let's talk about the Roth IRA. And this is where things get really exciting for a lot of people. With a Roth IRA, you contribute money you've already paid taxes on, after-tax dollars. The money grows completely tax-free, and when you take it out in retirement, you pay zero taxes on the withdrawals. Nothing. Not a penny. Think about that for a moment. If you contribute $7,000 to a Roth IRA this year, and it grows to $50,000 over 20 years, you pay no taxes on that $43,000 in gains. Ever. Roth IRAs also have no required minimum distributions during your lifetime. That means if you don't need the money, you can leave it growing tax-free for as long as you want, or pass it on to your children or grandchildren. The contribution limit is the same as the traditional IRA, $7,000 per year, or $8,000 if you're 50 or older. But there's an important catch with the Roth. Income limits. Here's something that trips people up. Not everyone can contribute directly to a Roth IRA. The IRS limits who can use it based on income. For 2024, if you're single and your income is above $161,000, or married filing jointly with income above $240,000, you can't contribute directly to a Roth IRA. There is a workaround called the backdoor Roth IRA, but that's a more advanced topic for another video. The traditional IRA has no income limit for contributions. Anyone with earned income can contribute. However, the tax deduction may be limited if you or your spouse also have a workplace retirement plan, like a 401k. So, first question, check your income. If you're under the Roth limit, you likely have the option to choose. If you're over it, the traditional IRA may be your primary IRA option. Or you'll need the backdoor strategy. Now we get to the heart of the decision, and it really comes down to one question. Do you expect to be in a higher tax bracket now or in retirement? If you expect to be in a lower tax bracket in retirement, meaning you'll have less income, then it makes sense to take the deduction now with a traditional IRA. Pay taxes when your rate is lower in retirement. If you expect to be in the same or higher tax bracket in retirement, or if you believe tax rates in general will rise in the future, then a Roth IRA wins. You pay taxes now at your current rate and never pay again. For younger workers just starting their careers, Roth IRAs often make the most sense. You're in a lower tax bracket now, so paying tax today is relatively cheap. For someone in peak earning years, say 55 to 60, the traditional IRA deduction might be more valuable right now. But here's the honest truth. Nobody knows exactly what future tax rates will be. That's why many financial advisors suggest having both types of accounts to give yourself flexibility in retirement. Let's talk about the rules for taking money out, because they're very different between these two accounts. With a traditional IRA, you can start taking withdrawals at age 59 and a half without penalty. Withdraw before that, and you'll typically pay a 10% early withdrawal penalty plus income taxes. And again, at age 73, required minimum distributions kick in, whether you want them or not. With a Roth IRA, you can withdraw your original contributions, the money you put in, at any time, at any age, without penalty or taxes. That's because you already paid tax on it. The earnings portion does have rules. To withdraw gains tax-free, your account needs to be at least 5 years old, and you need to be 59 and a half or older. This flexibility makes the Roth IRA a unique emergency option as well, though it's best used as a retirement account. So which one should you choose? Let me give you a simple framework. Choose a Roth IRA if you're young or early in your career. You expect your income to grow significantly. You want tax-free income in retirement. You want no required minimum distributions, or you want to leave a tax-free inheritance. Choose a traditional IRA if you're in a high tax bracket right now and want the deduction today. You expect lower income in retirement, or you earn too much to contribute to a Roth. And consider both if you want maximum flexibility, having pre-tax money in a traditional IRA and tax-free money in a Roth IRA gives you options to manage your tax bill strategically in retirement. One more thing to remember. If your employer offers a Roth 401k option, that's a whole other tool with higher contribution limits and no income restrictions. That's a topic for another video. Here's the most important thing I want you to take away. The best IRA is the one you actually open and contribute to consistently. Don't let the decision paralyze you. Whether you start with a Roth or a traditional, you are building your future, and that is what matters most. If you're unsure which is right for your specific situation, a fee-only financial advisor or a CPA can help you run the numbers based on your actual income and retirement goals. Use this video as your starting point, not your ending point. Thank you so much for watching Economics 1144. If this was helpful, please give it a thumbs up and subscribe so you never miss a new video. Drop your questions in the comments below. I read every single one, and I'd love to hear what's on your mind. I'll see you in the next one.